Hi everybody, today's video is really trying to demonstrate something really. So in a previous video on a Tuesday lunchtime session, I did how to trade news and events. And the whole idea of it was, look, if you're running trades into the data, you need to be really aware of it. It can create slippage, it can create very fast moving markets. We had that today with non-farm payroll. Now, I'm not against trading around data. I just don't want to trade before it. If I'm going to day trade, I need to be aware of it, and then I'll quite happily trade the reaction. And the reason for that is down to slippage and gapping and so on. So what we've got here is a chart for the Dow. It's the 2-minute chart with the dynamic trader indicators on it. Now we do have a short signal here that was triggered at 1:32. So the announcement of how many jobs were created or lost for the preceding month, that was at 1:30. That's when the data came out. And then this is the first candlestick afterwards. And there was a big fall of over 200 points on the Dow in that 2-minute period. Now, to be in the trade, particularly a day trade, before that data comes out and to remain in it over that data is a massive, massive gamble. Really, as day traders, it's not a good idea. What I wanted to demonstrate was that what happens a lot is that the markets can be quite subdued coming into major data. There isn't much more major than non-farm payroll, really. And what we've got here is you can see the bands. Okay, notice how tight they are before the data, and then how wide they are after the data. That's down to liquidity, it's down to volatility, the speed in which the markets move. Now, in order to day trade, you want speed. Now, there are certain markets that have more commonly associated with speed, the Dow, the S&Ps, a lot of them in indices actually, oil, gold, and so on. FX less so. Doesn't mean you can't day trade foreign exchange, but I think you have to pick your moments. And this is a really interesting time. Okay, so if I look at the Dow here, really tight movement, you shouldn't really be day trading into the data. Wait for the data to happen. That creates an event. There was a lot more jobs created than expected. That caused a big skid on the stock market. And that means a sort of tussling or repositioning of portfolios, and you get a much bigger, faster move on the market. So from that short there, I'm not saying a lot of our members would have taken it. It's quite a high risk trade straight after data, but a trade it was. From there at 32592, and then the market fell, another sort of 100 points or so after that within sort of 20 minutes or so. So it's a really big move and decent. The point I'm really trying to make is, I guess, that, into the data, no. Wait until the reaction, then we pick up the movement and speed after the reaction, as per the rules of the strategy. This announcement of the data created a trading opportunity for us from which we could extract a profit. Now that's the Dow, okay? Now, because it's quite a fast moving time for the market, it can bring other markets into the equation. Pound dollar, obviously, if it's something to do with US interest rates, which is what employment data is going to affect that. It's going to affect the dollar. So why don't we have a look at the impact on the pound against the US dollar as well? And we had a similar situation taking place there. So the market was turning down, started to think about it at 1:30. There's the announcement at 1:32, and that's when you see a lovely short progressing from there. Again, I'm not going to say otherwise. That is a higher risk trade, but the point I want to make about it is that it is to the right of this data point that it makes trading a lot more interesting, because the movements are likely to be bigger, okay? And the more movement, the bigger the movement, the easier it is to trade, the easier it is to extract a profit. Look how tight those ranges are there in the preceding hour before that economic data. Hideous, really difficult to trade, and Forex, generally speaking, on the micro time frames is quite challenging. And the reason for that is because a lot of moves can only be sort of 1, 2, 3, 4, 5 pips. It's not a lot, particularly after you factor in dealing costs, execution errors. You might enter a trade a pip or two late. Before you know it, you're really behind the trade. Whereas when you have more movement, it doesn't matter if you're a pip late, because actually the market's going to move 20, 30, 40 points instead of 1, 2, 3, 4, and 5. So it's not as sensitive to the errors that is actually quite normal to make. They're not really errors. It's just how one does it, really, I would say. So what you saw there was, well, typically a few pips there, not very exciting. Look at this move here, a good 40, 50, 60 points there within the next half an hour. Again, just an example of speed in which markets move after economic data. You saw something similarly with gold. Again, here there's the gold, there's the short, and again the market carrying on. Some big continued movement there. And actually really nice moves back to the upside. Again, that volatility, that movement, creating continued trading opportunities into the open of the US equity session. So really this is just an example of what to do, what not to do. If you're going to be a day trader, be aware of the major economic data points that are setting up for the day. You don't have to be an economic whiz kid. You just have to understand that items are coming out. They will create movement. Do not be in the market ahead of that. Look to be in the market after that. But make sure you stay true to your strategy. Just because the market's moving down doesn't mean it will carry on moving down. Be aware of your strategy, like we have here with Dynamic Trader. That gave us an entry and it gave us a continuance of that movement as well. As extreme as this example is, it is actually a great example of what can happen if you've got the right strategy and the right degree of patience. All the best, everybody. Have a wonderful weekend, and we'll catch you next time.